All right, great, everybody. Well, here we are at 1 minute after one, and our second series of the Ask the Expert, which I'm very excited about having a series. And today I have Donald Sharpe. Donald, how long have you been in the mortgage industry?
33 years.
33 years. So, so you've seen lots of ups and downs, correct?
I used to say I've seen everything twice by now, and now I have a new thing that I've never seen twice yet. Well, we're the first.
Well, that sounds great. So we have a go ahead, Donald.
That's it. It kind of mirrors a little bit of what, however, it does mirror a little bit of the 2007 crash on some levels, and with adding a few extra things to it.
Okay, got it. Great. Well, we've got a lot of questions here for you today, and we need your expertise. And then at the end of the show, or for people who are going to be watching this later, we'll be able to have your information in there as well to take it and all that stuff. So,
Thank you.
So I guess the first basic question is, are mortgages happening right now?
Yes, they are still happening. In some cases, it's sort of proceed with caution, so to speak. I mean, I like to be very transparent to borrowers, and on any normal circumstance, and in this case, I make sure everyone's aware that there's just constant rules changing every other day. Sometimes loans can be suspended and so forth. And we are proceeding taking loans, particularly standard purchase loans. There's a caveat to that.
What is considered a standard purchase loan?
The standard one would be the primary occupancy purchase loan in most states.
Okay.
So I operate in 7 states myself, and different states that are, well, all states now are declared as a part of the national disaster. So there's a separate rule that went into effect when that happened for as each state went into it. But so the simplest form of lending at the moment is it's going to be the primary occupancy, primary home.
Okay, and so that is still moving along. Now, as a real estate broker, I get in different areas about, rates are low right now. Rates were super low, then they went up a little bit. What kind of is the going rate right now, and where do you see it going, up or down?
Well, the rates have now been divided into 3 parts, which is the norm has been 2 parts forever, which means we have the conforming rate, which is the standard Fannie Mae rate with a limit of $510,000 for the most of the part. And we now have 2 categories of that, which is for purchase or refi. So refinances are actually considerably higher right now than a purchase is, believe it or not. That's the first time.
Why would that be, just as a quick side note?
The primary reason is that during the past 3 months or so, when rates kept dropping and dropping, the volume of refinance business quadrupled, and so many times it was unbelievable, to where most lenders had to change the rate in order to be able to facilitate what we already had in process and be able to service it correctly. So it wasn't like there was a giant surge in purchases, however. So the purchase interest rate remained the same. It's kind of a phenomenon. And then, so to answer your question about the rates, they're still relatively low. I mean, a standard Fannie Mae type loan up to 510 is about 3.75 or 4% at any given time right now, for no points. The jumbo loans is where we're seeing giant variances. And so since a lot of our business in New York is that.
Okay. And just once again, a jumbo loan is what, mortgages that are over 510,000?
For the most part, yes. Although in New York City and other high cost areas, we have what's called conforming and high balance conforming and jumbo. And so high balance conforming here means loans between $510,000 and about $726,000. It's its own category, which is not very favorable, by the way.
All right. And so anyway, so basically, so the loans really up to about 510, you're seeing about 3.75 to 4% without people buying down the mortgage. And
Correct.
going into it, the jumbo, or you called it, what was it, the high balance non-conforming?
High balance conforming
Oh,
loans.
high balance conforming. So yeah, tell us a little bit about the jumbo rates, because here, as well as some of the other areas that we serve, such as LA,
Yeah,
it's difficult to find a property in the
absolutely.
top 10.
So, so at the moment, for the first time in a long, long, long time, we're seeing the jumbo rates considerably higher than the conforming rates. Normally, we'd see if it was 3.75 on conforming, the jumbo would be the same thing, if not even a little bit cheaper. Now, because there's different risk in with the COVID-19 situation going on, the primary risk being the borrower's continued employment, then the the interest the the lenders are hedging their risk by either raising interest rates or charging points or both. And so the 30, for example, the 30-year fixed rate for a jumbo loan right now is like 4.875, more than 1% higher than the conforming, which is extremely unusual.
Wow, that is. And when did that happen? Did that happen just within the last like 3 to 5 weeks, or?
Absolutely. Yes.
Okay.
Within, as soon as the whole COVID-19 thing started becoming a bigger deal and a national emergency, the jumbo market itself started to more or less freak out, for lack of a better word.
I got you. And so just to talk about, like, so conventional wisdom would be that when things, in fact, quote unquote, come to a normal, or I'll call it a new normal, because we don't know exactly what that normal will be, you would expect that jumbo rate to come down.
Absolutely. Yes.
Okay, fair enough. So call it a medium temporary right now.
Also, I would
Go
like
ahead.
to point out one thing real quick. Since in some of our markets, it takes months to do a transaction in the first place, I feel like we are probably already within the target time frame where purchasers trying to proceed now should be able to relatively safely proceed with their transactions, which will take 2 and 3 months to close here at least, because the rate situation should be settling down within this time frame, in my opinion.
Understood. That makes sense. And that also probably would be good with other markets as well. For everybody out there, the New York City market specifically, from contract signed to closing, is about 90 days, 3 months.
Right.
Rest of the country, it's
30.
30 days or so, maybe a little bit less.
Correct.
Right. And then also, so my understanding also is that some of the are the banks now also tightening lending practices, i.e., higher percent down, higher credit scores, all that kind of stuff. What's
Yes.
the with that?
Everything going on now, again, particularly in the realm outside of the Fannie Mae size loan. And I'll say the reason there's a difference is because the Fannie Mae loans are quasi-federal backed in the first place. So they can't suddenly make changes overnight and all these various changes just because the market is changing like this. It's a very stabilized kind of source of lending. And so everything else, the conforming loans themselves aren't having these giant variations that I'm about to point out. But otherwise, the jumbo loans and certain investor purchase loans and things like this are having, across the board, the lenders have either suspended lending in some cases or required the loan to value to be dropped from 80% to 70% for one thing. Minimum credit score 740, maximum debt ratio 38 instead of 43. Some cases, some lenders have actually put a caveat that post-closing liquidity of $250,000 or more, which is completely, ridiculous, more or less. It's all, it's like worse than the co-ops. But the lender now requiring amazing amounts of post-closing liquidity, at least in order to get the absolute cheapest loan, particularly 7-year ARM or 10-year ARM or something like that.
I see. Okay. So just kind of with that then, so what are you recommending to your clients to do you want to maybe sit tight till late summer, early fall until all of these perhaps lending practices go back to what again I'm calling a new normal? Or are you suggesting, look, if it's $1 million property and you get the Fannie Mae, Freddie Mac backed security up to 510, maybe you should put down, 490,000 cash if you have it, borrow the 510, and then refi a year or so later?
Okay, so that brings up a very interesting point. In this particular category where the property prices are right around a million or just under a million, if the borrower was already going to be putting, say, 20% down, in this case, that loan amount would be just outside of the $510,000 maximum for the standard conforming Fannie Mae loan, which is the cheapest version and the safest way to go. It's the loan that will most likely close without a whole bunch of rigmarole and so forth. And so my suggestion at the time, for the present time, is that we are putting together piggyback loans for these people. And what that means is we're giving them, let's say, 80% of 999,000 or whatever the price is. And we will do a first mortgage loan of 510 and a secondary piggyback HELOC loan on top of it to bridge the gap. And the reason being is because the HELOC, the combination of those two, is considerably cheaper to the consumer than taking one single 80% jumbo loan.
Wow.
Now, there is one negative caveat to it, which is that the HELOC portion itself, which currently is only about also 3.5%, it's actually lower than the fixed rate is. It is possible to be, it's an adjustable loan according to prime at any given time. So over periods of time, it can change up and down by 0.25% or whatever else. And so in some cases that's bad, in some it's good. Right at the moment, the odds of prime rate getting worse anytime in the foreseeable future is practically zero. Right. And so the
loans by worse, you mean going up?
Yes, correct. So the economy will take quite some period of time to recover from all this. And so we are going to see an unusually long period of time, in my opinion, of how long it will be between adjustments upwards of many of these, the federal funds rate or the prime rate, either one. So that makes this kind of combination loan that I'm describing that much safer. That said, also, as you say, down the road, any of these loans could be refinanced in the future if there's a valid reason to do so or whatever. At the moment, I don't recommend that any buyer necessarily just sit around and wait it out or anything else. We're still in a buyer's market in many of our markets at the present time. And so my thought on this is many of the people I'm dealing with right now are flat out taking advantage of this fact. They're going to still get a very reasonable loan, or just as cheap as they ever were going to get. Even the ones getting the jumbo loans, 4-point-something% or 5% historically is low. Over the history of 30-some years I've done this. And so there isn't any reason, in my opinion, to halt purchasing or sit around and hem and haw, particularly in any of these buyers markets.
Understood. And so that kind of brings up a point. I mean, kind of and again, forgive me if this is a very remedial question, but the idea of I'm going to take a 30-year fixed rate and I'm going to be stuck with the same mortgage for 30 years. Nobody really does that anymore, do they?
No, pretty much not. I mean, of course, in New York, sometimes we have the people that are going to buy and stay in for quite some period of time, but still, I'd say for the average consumer, a 10-year adjustable rate loan is more than enough time for them. When they're applying, I'm asking them questions such as, you need to, step outside of your own box for a moment and think of, will you be transferred? Will you have children? Will you need to buy? Are you likely to buy up? Are you likely to have an increased income? And all these different factors that make people sell and move later. Particularly co-op buyers, they can't necessarily just rent the property when they buy another one. And so most of them sell their co-ops. And so the flip side to that is the 10-year ARM, these ARM products like this that are anything other than the 30-year fixed is primarily for the jumbo buyer in the first place. They aren't really any good than a 30-year fixed rate loan is for the consumer right now, would be anyway. So it's for the conforming people. They may as well just take the fixed. Anything outside the conforming, they should take a 10-year ARM or consider it at least.
Okay. And what is the rate of a 10-year ARM now? Is that still at the 4.875 or is that a 30-year fixed you were quoting?
That was a 30-year fix. And so the 10-year ARM rate at the moment is like 3.75%, which is considerably better. It's going to be a very, very strong type of loan, in my opinion, for some period of time. So this would be for people that are, in some cases, it will make more sense to do that at 20% down, even at $1 million, than it would be to take the fixed combo I just referred to, or anything like $2 million and putting 25% down and so forth. Those make sense instead as a 10-year ARM.
Right. And what's also nice, again, about a 10-year ARM, and correct me if I'm wrong, is that it's great for somebody that is, you know, that's probably has a bonus as part of their salary compensation, so that every year you could pay down the mortgage or the principal if you want to. Is that correct?
Yes, but no. I mean, any of the loans allow you to pay them down at will.
Okay.
None of them adjust the payment to do so. Now, for example, any loan, you can just pay down principal anytime you want, and the loan is going to stay the same payment for the duration of the period that it was fixed in the first place. So any standard 30-year fix will always have the same payment, no matter if you put $50,000 down, hundreds of thousands of dollars down. You will shorten your term. Now, to your point, what is a good use of what you just said is when people need to put less money down, like let's say 10% even, or 20, if not for co-ops, but you know, the minimum would be 20. But when we do these combo loans, those loans themselves can be paid down, leaving the first loan the way it is, pay the second loan down, and since it's recalculated every single month according to what prime is at that month, their payment actually drops. So for people that are going to get bonuses down the road, these combination loans are especially good for them because they'll get a much cheaper deal. The first mortgage loan will stay at a low interest rate forever, and the second loan can be paid off by half or 100, all of it, or whichever, and with extra money that they get. So as if they were delaying their down payment. They're putting 20% down one time and another 20% down another time, and they're having one single loan from $510,000 instead of dropping the balance. Well, the actual payments completely drop into just the remaining one loan. Does that make sense?
Yes. So I'm just going to do a quick recap on that just to confirm it. So, you know, hypothetically, and maybe Jared, you can do graphics on this later. Hypothetically, if it's $1 million property, New York, of course, would be 999 to avoid the mansion tax of 1%. Right. But let's say it's $1 million, and you want to put 20% down, so that leaves $800,000. You do the 510.
Yes.
The Fannie Mae, Freddie Mac backed, and so the balance would be 290, if my math is correct, within HELOC. And again, that's that's HELOC. And what does that stand for?
Home Equity Line of Credit.
Got it. And that right now, so you can get, just a quick technical question, then I want to go to Whit's question. You can get a home line of credit before you actually own the home? Or how does that work?
You get it to buy a standard fixed rate second mortgage. Both of those can be done, but most all cases is this home equity line of credit. And so it's a purchase home equity line of credit. It can't be in first mortgage position though, so it goes behind another purchase first mortgage.
Got it.
So
that's great.
Does that make sense?
Yeah.
Okay.
Absolutely.
So basically, we're able to sit there and we do two loans. I'm going to do the one loan at 510, and on this 510 loan, I'm disclosing that there is secondary financing. It's called CLTV, loan to value and combined loan to value. And so we will have one first mortgage that might be 65% loan to value, and a second mortgage that's another 15% or whatever, and we'll have a combined loan to value of 80. And so the first mortgage acknowledges that the second mortgage exists, and there's limitations to it. as far as you can't just have like 99% loan to value or some other crazy things. There's a certain specific list of checklist of how to make it work. But the both loans recognize that the other one is happening. The second loan, at the closing, the first loan closes and the second loan funds 100% of it, because this loan is subject to being able to pay it up and down. So let's call it $150,000. Then they're going to fund a $150,000 home equity line of credit at the closing. This means that now the borrower has combined loan to value of 80%. It's just split between two different loans. And now the interest rate of the first loan, in this case, was a fixed of like 3.75 or whatever. And then the interest rate of the HELOC part is variable according to prime plus a figure that equates to that individual person's credit score and certain other factors. There's one assigned to each borrower slightly different. So the better the credit score, etc., the cheaper the HELOC is. But at any rate, so the two fund all at the same time, and the borrower literally has two mortgage payments to make. Now, on that note, again, the HELOC is like a giant credit card. So let's say it was $150,000 and the borrower's about to get a $75,000 bonus in 2 months. If they wanted to, they could just pay down the HELOC with $75,000 and have only a $75,000 balance remaining. That means, excuse me, that they're going to have that interest rate on that new balance. So their second payment has dropped. First payment's still the same. So the payment can vary. Then say the next month, the borrower all of a sudden wants to do some repairs. It wants to access the HELOC. They can pull out up to its limit again at any time they want to. So they're kind of getting, sometimes borrowers buy the homes and years later they take a HELOC. In this case, they're getting the HELOC at the time they close. It's extremely flexible. The only negative to it is the fact that it can vary in interest rate over time, which at the present time is extremely unlikely.
So for medium term, you think it's a good. I want to jump on to questions here. As I mentioned earlier, Donald, the half hour usually goes by really fast.
Yeah.
So Whit asks, how long before you think it will be prudent to refi out of the conforming and HELOC into a single loan, or will it be likely or not necessary? So you answered, I guess, kind of part of that, but did you want to kind of reframe it or add anything, Donald?
Well, I think it's up to the individual consumer's tolerance for risk. So the fact is, if in, let's say, 5 or 6 months from now, the whole market should be really stabilized and all this stuff, and interest rates in themselves should in fact be stable or low anyway. That same consumer may consider that they have one opportunity right at that time to change it into one single loan of a cheap amount of a low rate or whatever, and get rid of this possible varying risk down the road. The negatives, that's a plus if they're going to stay in the home a long, long time. The negative is the closing costs to do this aren't necessarily cheap either. If the property, since these HELOC loans don't work on co-ops at all, by the way, the property would have to be a single family home, multifamily, or a condo. And so the part of the closing cost will still be applicable to refinance this into a single loan. Because they can do what we call a SEMA, which avoids having to pay the mortgage tax twice. It isn't anywhere near as much on the closing cost as the purchase was, but that's a factor to consider, whether you want to spend this much money to now get rid of the risk. It's not going to necessarily make the payment any cheaper. It's just going to get rid of any future risk for that person. So it's kind of up to their risk tolerance. I would say the odds are most of these can very safely keep them just the way they are.
Right. At least for the next, 36 months or so, right?
Yeah.
So we're coming up. We got about 5 minutes left. Was there anything you wanted to talk about, Donald? I know on our pre-call you had some thoughts and ideas, and I wanted to make sure we covered the topics that you wanted to discuss.
The one thing was just the issue about the making sure that people understand that they can do these combo loans as purchases. The other is, I just want to point out that the restrictions that are going into place at the present time are almost entirely based on the fear of the consumer losing employment. And so, again, the Fannie Mae size loans are very, very strongly backed, and they don't have the capacity to suddenly change their rules and nitpick about some of these, even though this is a very big topic, obviously, that losing their jobs, but it is still considerably safer and more reliable that these loans will close with far less roadblocks or and so forth down the road. Like what we're seeing is our Fannie Mae loans are closing much faster and more easily right now than any of the jumbo loans are, because for lack of better term, some of the lenders are practically trying to find reasons for why they should not have to honor these other loans. They've either suspended entire states that they won't loan in at all during the time of the national state of emergency, or they have all of a sudden changed these restrictions in the middle of the loan to the loan to value, requiring a much bigger down payment than they already agreed to when the loan started. Now, this doesn't happen on the Fannie Mae loans, which is what the point I wanted to make.
Okay. Well, I mean, that's helpful to know on what's going on with everything. All right, so I think we covered a lot of stuff. Any other viewers out there, is there any other questions that you guys have, or you want to shout out a question? All right. One thing also, just quickly, I just have a few minutes left. With people that have, that are in the mortgage application process now, how does that work with banks? If they change lending practices, let's say yesterday, and they had a mortgage application out a week or two ago, or even a month ago, does that impact them or not? Or is it case by case, or how does that work, Donald?
In almost all cases, it's going to go into effect for anything already applied for. And so they will, and because what they define it as is other than clear to close. And so if a loan is in application and being processed at this moment, at any time, any of these jumbo lenders or non-Fannie Mae type lenders can suddenly change the guideline and state that effective immediately, all loans in process must meet this, this, and this in order to close. The only exceptions that I've seen so far are that loans that are 100% clear to close and scheduled. And so this is the problem we're having to deal with here, is juggling these things and letting the consumers know that up front that, it's going to be a little bit of a bumpy ride, or it could be that they understand this is not the norm, and we don't like it any bit more than anybody else. I hate being the messenger of some of these bad news, but I really, really want to be transparent at the very beginning of this, that we're proceeding as fast as possible, and it's kind of like borrower beware.
Understood. One last question. Sean Wilson asked that he wanted to know if you could just give us, it's, I guess, truly going to be an elevator pitch, if you will, with a minute left or so. How are you different than a lending? If I would go to Chase Bank and I want to talk to the mortgage broker, I meet somebody at Chase Bank, for example. How are you different than a direct bank lender?
That's a great question. Well, for me, myself, I'm an independent mortgage broker / mortgage banker. And that means that there's the big boys in the world, which is the Chase, the Citibanks, and so forth, and there's all the independents. How we operate as independents is we are correspondent lenders with the big boys. So in a roundabout way, I am representing Chase, Citibank, Santander Bank, and a whole bunch of other banks at the same time, which FM Home Loans more or less co-lends with. We process the loans, we underwrite the loans ourselves and everything else, and close them in our name, and with the intent that they're going to sell to this, that, and the other lender. So when the consumer comes to me, I'm like the middleman offering a whole bunch of other lenders' products, if that makes sense.
Absolutely. And just one technical right there is, or a technical question, I should say, Freudian slip. if somebody comes to you instead of going to Chase directly, is there a rate difference? Is Chase going to give them a better
No,
rate going to you, or is it the same?
no, not unless they're going to a thing where they've got millions of dollars. Some of the average consumer can't do that. So the wealthiest consumers are always going to go to their own private bankers. They've already got people handling their money. We don't expect to get their business, and I will immediately admit they're going to get a better deal because it's not even the normal loan at all. But for everything else, they won't get a higher rate coming through me. They're not going to get any more points or fees. They're just sort of going to, I pride myself on my service level and all those sorts of things. And lastly, I'll say this: my business is 100% derived from real estate agents. We don't have account holders and people already walking in the door in the first place, as opposed to Chase and other major banks. So Chase's fiduciary duty, so to speak, is to their own clients first and anybody else later. My fiduciary duty is to everybody.
Understood. All right. Well, that's great. Well, we're out of time on that. Donald, once again, thank you so much, Donald Sharpe of FM Home Loans. And we'll have your name and contact info on this for the rebroadcast. Donald, thank you again. I really appreciate it.
My pleasure. Thank you.
All right. Have a good day, everybody. Take care.